So I have the honor of talking to you guys today about the proposed changes to the tax planning for private corporations, as Les mentioned. On July 18th of 2017, Finance released a 63-page consultation paper with draft legislation that basically outlined significant proposed changes to our tax system for private companies. So I'm not going to get into the politics of it. I know there's lots of articles about it. You guys don't want to hear me for 25 minutes rant about that. I'm going to get into the nuts and bolts of it. There's a lot of material to cover. We went to the tax conference on Monday and Tuesday, and even in a 50-minute period on one area, they could barely cover it. So this is going to be an oversimplified and very generalized summary of all the changes, and it's just, again, to give you guys the nuts and bolts of what's going on here. So let's get started. So I'll quickly go through just so you guys understand how I'm going to lay it out. I'll just give you a quick overview of what's going on. There's three key areas that the government is proposing to change for private companies. That is the income sprinkling for private corporations, holding passive investments in private corporations, and the conversion of income into capital gains for private corporations again. And then I'll just finish off with a quick highlight from the BC budget and the small business deduction changes. So let's just jump into it. So the last couple of years, there's been this growing trend, as many of you know, with the Canadian government wanting to alter tax planning strategies for Canadian private companies. It's this gradual shift or desire to want to shift wealth from the high income earners to the middle income earners. That's basically their agenda. Last year, I presented on a topic relating to the small business deduction changes and the multiplication of the small business deduction, and which has now been implemented. And like I said, on July 18th, they released a 63-page paper, very detailed, with draft legislation that went through the potential changes. So let's get into it. The first area that we're going to be seeing changes in is income sprinkling. So us tax people always use that term, income sprinkling. Sometimes people say, well, what is income sprinkling? It's a concept of shifting income from high income earners to lower income individuals, usually in the same family, in order to take advantage of the low marginal tax brackets in our Canadian tax system. So for example, if I own a company and my wife is also a shareholder, but she's not really necessarily involved in the company, and I were to just receive all the dividends, I would just get taxed at the top rate. Not an ideal situation. So what I would normally do is maybe pay dividends to her. If she's not working or she has low income, we can take advantage of her lower marginal tax brackets and effectively have overall less taxes versus if I were to only receive the dividends. So that's, long story short, how income sprinkling works. So the finance is proposing two main changes to income sprinkling. One is on the extension of the tax on split income rules, or what we commonly refer to as TOSI for short, and then the constraining of the multiplication of the lifetime capital gains exemption. So I'll speak about both of those topics separately. So the way the current TOSI rules work, so I'll commonly refer to TOSI as sometimes kiddie tax. If I say kiddie tax, that's what I mean is the TOSI rules. There are already anti-avoidance rules in our Income Tax Act that prohibit income sprinkling with certain types of individuals, and specifically with the current TOSI rules, you can't split income with minors, so people under 18 years old. So again, the most common application you'd probably see is if, again, using myself as an example, if I had a kid, say 15 years old, and they held shares in the company, if I decided to pay dividends to that person, the child would get taxed at the highest marginal rate. So there's basically no reason for me to distribute income to that individual from a tax planning point of view. So what the current TOSI rules don't cover are distributions to spouses and adult children. So again, as I mentioned earlier, if my spouse is also a shareholder, I could pay dividends to her and we could take advantage of the low marginal tax brackets. Also adult children, so if you think of a common situation where you have university kids, you could pay dividends to them, help them pay for school, and again, you could take advantage of their low marginal tax brackets. So very good planning tool right now to use when you're paying dividends to spouses and adult children. So if we I know everyone always likes to see diagrams. I think it helps to emphasize points better. If you just look at a simple example, you have Smith & Co. It's an operating company, it has active business. Mr. Smith is the principal operator, and he has his family basically shareholders of the company through a discretionary family trust. Very common setup. I'm sure a lot of you guys have this type of structure. So under the current TOSI rules, the question is, well, how do the current TOSI rules work, or how does income sprinkling work in this type of situation? Well, if OpCo were to have some excess profits and they wanted to distribute dividends to the family, the OpCo would pay dividends up to the family trust, and the family trust would allocate that income to the various beneficiaries. So the beneficiaries include both adult and minor children. You'd probably not actually allocate income to the minor children, because again, you wouldn't be able to take advantage of the low marginal brackets. You'd have kiddie tax apply, but if Mrs. Smith and the adult children have low or no income, you're basically able to take advantage of their low marginal tax brackets. On an overall family basis, you're paying less taxes. If the family decided down the road to sell OpCo to a third party, well, how would that work on the capital gains exemption? Well, effectively, you can multiply the lifetime capital gains exemption across the whole family. So, and I'll elaborate on this a little bit more. Everyone has a lifetime capital gains exemption of about $836,000 currently. So for a family of 4, you could shelter up to about $3.3 million in capital gains on certain types of private company share sales. And that would actually include, which surprises a lot of people, is actually minors are actually able to also claim the capital gains exemption. So on dividend income, for example, you might not be able to split, but on the capital gains exemption, you can. So again, a very powerful tax planning technique under the current rules. So let's get into what the proposed rules are. So there's a couple of main areas that are going to change for the TOSI rules. Mainly, as I mentioned earlier, the TOSI rules only really apply to minors. It's now potentially going to apply to all individuals, Canadian resident individuals that are related to a person that's connected with the business. So, for example, in that Smith example, the spouse and the adult children are now potentially affected by this rule. And secondly, there's this new concept of the reasonableness test. So now, in order to determine if the TOSI rules apply, or like the kiddie tax, you now have to determine if that dividend, for example, is considered reasonable given the circumstances. So this reasonableness test, when I read the consultation paper, it was just, it's a huge fundamental change to how dividends are being paid, right? I think most people are familiar with the concept of reasonableness as it pertains to salaries. If you have a company and you want to pay your spouse for services rendered, it needs to be a reasonable amount in order for it to be deductible to the company. Now they're going to be introducing this concept of reasonableness for dividends. So, and there's 2 areas it's going to look at to determine if it's reasonable, and that's looking at their labor and capital contributions. And interestingly enough, the rules are actually going to apply differently based on the age of the individual. So the test is actually a lot more strict for 18 to 24-year-olds. You'll see the wording in the consultation paper. For 18 to 24-year-olds, they would need to be actively engaged in the company for the labor test to apply for it to be reasonable. Whereas for 25 and older, they just simply need to be involved in the business. So definitely a huge change to the current rules. So the question we always get are, when are these rules going to apply? So Finance has indicated that these rules will apply for 2018 and future years, which means you'll have one last kick at the can for the 2017 year to basically take advantage of the old income splitting rules, whereby, again, you could pay a discretionary amount of dividends to your spouse and adult children without being subject to this reasonableness test. So so that was kind of 1A of the income splitting rule changes. There's another component to the income sprinkling changes, and that's on the lifetime capital gains exemption rules. So I think most people are at least somewhat familiar with the lifetime capital gains exemption on the sale of certain types of private company shares, like QSBC shares, for example. You can actually shelter up to $836,000 of capital gains from tax. It's a great planning tool technique. A lot of private companies rely on it when they're selling their business to third parties. And that effectively allows the multiplication. The way the current system is set up, you can actually multiply the capital gains exemption across the board in the family. So again, if you have 4 family members, you could shelter up to $3.3 million of capital gains, and that actually includes minors as well. In the context where you have a trust, the trust, again, there's in the Income Tax Act, the trust can actually distribute that capital gain to the beneficiaries, and the beneficiaries could claim the capital gains exemption on their respective personal tax returns. So again, these are how the current rules for the lifetime capital gains exemption work. So what are, again, the proposed, the proposed changes for the capital gains exemption? So there's going to be, one of the biggest changes is now going to be this elimination of the capital gains exemption for minors, regardless of their involvement with the company. So if you have little Billy working the cash register, unfortunately, he will not be able to claim the capital gains exemption anymore. They're going to be introducing this reasonableness test as well, very similar to what I mentioned earlier with the dividend rules. So again, even if you have an individual, let's say a spouse, that is a shareholder of the company, and you guys go to sell the company shares, the question becomes, is it reasonable? Did that spouse have a reasonable amount of contributions to the company that would allow that capital gains exemption to be claimed? And thirdly, is this elimination of the capital gains exemption for any gains that have accrued in a family trust. So again, in that example I mentioned earlier for Smith & Co., if there's no tax planning done, that family trust, none of the beneficiaries of that family trust would actually be able to claim the capital gains exemption. So really, really big and profound changes to the tax legislation. So for the capital gains exemption changes, these rules are going to be for the 2018 and future years. Luckily, as much as finance is kicking us when we're on the ground already, they are going to give us some transitional rules that will actually allow people or families to crystallize their gains at some point in 2018 to take advantage of the lifetime capital gains exemption. And what that means, what that term means, again, crystallization is a tax term. It basically means you purposely trigger a deemed disposition of the shares, even though you might actually still hold the shares. And that deemed disposition allows a gain to be created and that capital gain exemption to be claimed. And moving forward, you would have a higher cost base. So again, the way that rule would work is it would be an election. It would be done on an individual basis. And for those of you who are familiar with the QSBC rules, Qualified Small Business Corporation Share Rules, in order to claim the capital gains exemption, there's certain criteria that need to be met. One of the rules is that there's a holding period test, for example, for 24 months. In order for that criteria to be met, the government has said that they will reduce that requirement to only 12 months to allow these transitional rules to operate effectively. So let's go back to that example I gave earlier about the Smith family and see how their situation is now going to change. So again, you have Mr. Smith that owns the shares of OFCO, and the family trust owns the shares as well. If OFCO decides to distribute income, dividend, OFCO pays dividends to the family trust, and the family trust then allocates that dividend income to the beneficiaries. The question now becomes, are those dividend amounts reasonable given the circumstances? Have the children or has the spouse contributed any capital? Have they contributed any labor to the company? If it's considered to be unreasonable, then the TOSI rules will apply and the top marginal rate will actually apply on those dividends. on the sale of the OpCo shares in the future, again, if no tax planning is done, there will actually be no ability for any of the beneficiaries to claim the capital gains exemption. In theory, only Mr. Smith would probably be eligible. So again, really big changes to the lifetime capital gains exemption. So that was, I would say, of the three areas that finance is proposing to change, that is probably the biggest one in my eyes. This one is probably a very close second, and I think it's been getting a lot of discussions in the media. So finance is proposing to make changes to passive investments held in companies. So just to kind of give you an overview of how this concept works, due to the low corporate tax rates, when business owners have excess cash, they have the ability to invest that money in passive investments, GICs, stocks, rental properties, for example. Whereas with an individual, if they were to take their after-tax cash and invest that, in their RSPs or non-registered accounts, they would actually have a lower starting cost base or a lower initial capital base for which to invest, because again, the corporate rates are quite low. The small business rate right now is about 13%. The general rate is about 26%. For personal taxes, many of you know the rates, teetering on almost 50%. So for every $100 that an individual without a corporation wants to invest, they only have 50 cents on the dollar, whereas the corporation, the business owner with the corporation has a little bit more. So finance doesn't like that concept. They don't like the fairness of that system, that business owners actually have the ability to have a higher initial capital base, which means, for example, after 30 years, that business owner has a higher portfolio versus an individual who has no company to use. So they are now proposing changes to this particular legislation. So if we kind of just elaborate a little bit on how the current passive investment rules work, the way income integration is really important to our tax system. What that income integration means is that you are basically indifferent between earning income through a corporation or earning that income personally. So if you think of an example, if I were to receive consulting income of $100 and I received that through my corporation, I paid corporate tax, and then that excess amount I pushed out as a dividend to myself. I paid personal tax on that dividend. The after-tax cash that I have should be, in theory, the same as if I were to receive that consulting income personally without the use of a corporation. If you look at the rates, there's maybe about a 1% spread. So in theory, you're basically indifferent between those situations. But again, as I mentioned earlier, the main difference, using that example I just gave, is with a corporate setting, the business owner has the ability to choose when that dividend gets pushed out and to what extent. And by having that control, you can actually leave the money behind in the company, invest it, and again, you have a higher initial capital base to start investing. So with the proposed changes, out of the three areas, finance actually didn't draft any legislation because this is a pretty radical change. I thought the first one was actually pretty big, but I guess this is a pretty close second. What the government is trying to do is remove the incentive, again, of leaving money behind in the company and investing it. And so they introduced a couple of concepts in their consultation paper that they're thinking about implementing. One of them would be to actually remove the refundable portion of Part 1 tax on investment income. So if I just elaborate on that a little bit, if I have a corporation and I receive $100 of interest income, I pay at some stupidly high rate of close to 50% on that interest income. And then when I pay a taxable dividend out to myself, a portion of that 50% tax actually gets refunded back to the company. And what the government or finance is saying is that they want to remove that refundable portion of that 50% tax. I think I was reading an article the other day, and they said in Ontario, if you, under these new rules, if you were to have investment income in the corporation and then flow it out, you're effectively paying, I think, a 73% tax in Ontario, which is quite ridiculous. So you earn $100 of interest income, and somehow you end up with $27 afterwards. And one of the other concepts they talked about was potentially reducing or removing the inclusion of the non-taxable portion of capital gains to the capital dividend account. Again, the idea behind that is to remove the incentive of leaving money behind in the company to invest. What they want business owners to do is basically take that money, pull it out, for example, as a dividend, and invest it in their RSPs or through a non-registered account under their personal name, and be on the same level playing field as an individual who has no corporation. So finance has indicated, again, there's no draft legislation yet, but they've indicated that this is going to be on a go-forward basis, meaning any passive investments already in the company are not supposed to be affected. We'll see if that really holds up, but currently that's where it's at. So, and then just one thing I should have kind of mentioned at the beginning is this is a consultation paper, so finance has asked for comments and feedback from the community, from the public, from tax practitioners up to October 2nd. So, if any of you guys want to make some comments or email the government, go ahead and you can give them your 2 cents on it. But I imagine, after that consultation period is done, that's probably when they're going to start drafting the legislation for the passive investments. So the third area, which I don't think is as significant, is the conversion of income into capital gains. As many of you know, capital gains have a lower personal tax rate compared with dividends. For example, in BC, on a combined rate with federal, you're paying about 24-25% on capital gains, whereas with dividends, you could be upwards around 40-41% on, for example, a non-eligible dividend. So where possible, there's this kind of motivation to want to convert. Anytime you're extracting money from the company, if you can somehow convert that dividend income to a capital gains, you're going to be better off. And so there's a lot of tax planning strategies around doing that type of, trying to get that lower rate. The Income Tax Act does have some anti-avoidance rules, specifically under 84.1, that ensures that you don't convert dividend income over to capital gains. So finance has proposed to expand these rules on certain types of non-arm's length transactions. 84.1 is actually a really, I kind of, last few days I've kind of battled on how I was going to present this particular topic, because 84.1 is quite complicated. It's actually one of the areas, it's probably the provision I think that gets advisors sued the most, because it sounds simplistic, but it's sometimes very difficult to detect. So I want to refrain from going too much into the detail of how 84.1 works, but just know that the rules are going to expand on it, and it would effectively grind the cost base on certain types of non-arm's length transactions. One thing I do want to add, though, and when I read the consultation paper, I don't necessarily know if the government necessarily intended this situation to apply, but under these new rules, post-mortem pipeline strategies will actually be impacted. I know some people have no idea, I guess, what a pipeline strategy is. Just to break it down really simply, many of you know, if an individual, for example, owns private company shares and they pass away, there's a deemed disposition on death of those private company shares, so that normally will trigger a capital gain. If the estate then holds those shares and decides it wants to wind up the company, it will actually trigger a deemed dividend on that redemption or that wind up of that company. So there's actually 2 layers of tax, one on the death, and then again a dividend on the redemption or the wind up of the company. So what the pipeline strategy does is through the use of another company, it actually eliminates that deemed dividend on that redemption or the wind up of the company. So it's a very powerful planning tool that we use, especially in estate planning, to avoid that double taxation. And when you read the rules, the consultation paper and the legislation, this actually would fall in that. And whereas the CRA used to say that the pipeline strategy they were fine with, under the proposed rules, that deemed dividend on the redemption or the wind up of the company would actually be triggered, and you'd have 2 layers of tax. So not a great result, and we'll see if there's going to be some changes to that, because again, I don't necessarily know if that's really what was intended with this legislative change. So this particular anti-avoidance rule, or the expansion of the 84.1, is going to be effective for share dispositions on or after July 18th, 2017. So that's kind of and I'm already kind of running over time, so, and I realize I went through that really fast. That's pretty much the end of the consultation paper. I thought it would just kind of give you guys some quick highlights to maybe soften the blow a little bit, although I don't really know if that was the case. The BC budget tax highlights. So there's going to be an increase in the top personal rate for BC by 2.1% on any income over 150,000. So on a combined basis, our tax rate is now 49.8%, which is looking very similar to Ontario, unfortunately. So that's going to be effective for 2018. On the corporate side, there's going to be a slight increase to the general rate by 1%, and that's effective for 2018 and moving forward. So the combined rate will now be 27% instead of 26%. And hooray, we have a small decrease to the small business rate by 0.5%, effective April 1st, 2017. So the combined rate will now be 12.5% instead of 13. So we win sometimes, I guess. And just one other thing on the small business deduction changes. This is a topic I presented last year, but I thought it would be important to make sure you guys remember about this. The government implemented some new rules that reduces the ability to multiply the small business deduction. It's going to affect a lot of corporate partners, of partnerships, and certain types of intercorporate transactions. That's going to apply to tax years beginning after March 21st, 2016. So that means there actually might be some T2 returns out there for 2017 that are already impacted. I guess if you have a March 31st, 2017 T2 return, you might actually be impacted by these rules already. So just be aware of that. So just in conclusion, obviously there's some huge changes coming down the pipeline relating to private company taxation. It's going to change the landscape dramatically. Moving forward, things that you guys should be aware of: review your corporate structures, figure out, are you going to be impacted by this, and does anything need to be done? I agree with Lester in the sense that you want to be careful not to have any knee-jerk reactions and do anything too quickly, in the sense that this is still in draft form. Again, the passive investments, the draft legislation isn't even out yet, so we'll see on that. Do take advantage of the income splitting opportunities. Again, if you have if you have corporations and you have spouses that are shareholders or adult children, you can still take advantage of splitting income with them for 2017. So take advantage of that as much as possible. And on the capital gains exemption, definitely figure out if anything needs to be done. I mean, $836,000 per person is a lot that you can save. It's not good enough, I think, to just bury your head in the sand and hope nothing will happen. Consider if the transitional rules make sense. If you need to crystallize, and if you have to crystallize, do you have to get all the other criteria met for your shares to qualify? And in tax, we commonly refer to that as purifying, meeting that 50% test, that 90% test, and valuations will start to become really important when it comes to crystallization, and I think Alex is going to talk about that later on. And the one big thing, Bill Davidson always loves mentioning this, is AMT, alternative minimum tax. So many of you know, when you trigger the capital gains exemption, a lot of times alternative minimum tax will apply. So even though you are sheltering the capital gains, you actually might have this upfront tax called AMT that might be payable in the current year. It just becomes a credit you can apply in future years, but sometimes that can be significant. It could be somewhere in the neighborhood of $40,000, for example, per person. and that sometimes blindsides a lot of our clients when we're triggering the capital gains exemption. So keep that in mind. And with that, I'm going to switch it over to Francis to talk about U.S. tax.